I'm going to explain something that's happening right now in markets that most people are completely missing. And by the time the majority figures it out, the opportunity will already be gone. Physical demand just surged 250%, not 25%, 250%. That's not a statistical blip. That's not market noise. That's a fundamental shift in how serious capital is positioning itself. And if you're still watching financial television trying to figure out what some analyst thinks about next quarter's earnings, you're looking in the wrong direction entirely. Here's what separates people who build actual wealth from people who stay stuck in the same financial position their entire lives. The ones who stay stuck watch price movements. The ones who build wealth watch capital flows. The stuck ones trade paper contracts. The wealthy ones own actual things. And right now there's a massive gap opening between what most people think is happening and what's actually happening beneath the surface. Let me be extremely clear about what I mean by physical demand exploding. I'm not talking about some line on a trading terminal moving up or down. I'm not talking about futures contracts or options positions or any of that derivative complexity that retail traders obsess over. I'm talking about real demand for real assets, actual inventory moving from sellers to buyers, real people stepping up with capital and saying, I want to own this tangible thing, and I'm willing to pay for it right now. That is fundamentally different from someone speculating on what a price chart might do tomorrow. Most people think markets move based on news events. That's actually backwards. Markets move based on positioning. News is just the moment when everyone who didn't understand the positioning finally realizes what already happened. By that point, the smart money has already repositioned somewhere else, already moved to the next opportunity. What we're seeing in physical markets right now is that institutional capital is repositioning, and they're doing it quietly, away from social media chatter and television commentary and public announcements. Think about this logically. If you're managing billions of dollars and you want to shift exposure from paper financial assets into real, tangible ownership of scarce resources, do you announce it publicly? Do you go on television and explain your strategy? Of course not. You move quietly. You accumulate through multiple channels, multiple counterparties, different geographic markets. By the time the public realizes you've been buying, you're already positioned, already protected, already ahead of where prices will eventually move. That's exactly what's happening with this surge in physical demand. Institutions have already done their analysis. They've already studied supply constraints. They've already modeled what happens when certain assets become genuinely difficult to acquire. And they've already started moving capital. The physical demand explosion we're seeing now isn't the beginning of this repositioning. It's visible proof that the repositioning is already well underway. Now here's where most people get this completely wrong. They see a surge in physical demand and assume it translates into immediate price spikes. That's not how this mechanism works. Physical demand tightens available supply. Tightening supply creates a foundation. That foundation builds slowly at first, invisible to most market participants. But once enough players recognize that supply constraints are real, once they understand that ownership is becoming more valuable than speculation, once serious capital starts flowing toward real assets and real yield, that's when price follows the fundamentals. And when price follows, it doesn't move gradually. Let me give you the unvarnished truth about how markets actually function. There's a reason the wealthiest people in the world own real assets. It's not sentimentality. It's not nostalgia for physical ownership. It's because real assets possess something paper never will. They have genuine scarcity. They have utility. They have people who actually need them. When scarcity combines with genuine need, prices don't rise because of emotions or sentiment. Prices rise because supply literally cannot meet demand without moving higher. It's mechanical, not emotional. The difference between owning something physical versus speculating on paper is fundamental. When you own physical assets, you own the actual thing. You own the risk, absolutely, but you also own the entire upside. When you speculate on paper derivatives, you're making a bet on what someone else will pay later. You're not owning the upside. You're renting a temporary view of it. During periods of market stress, during genuine economic uncertainty, renters get liquidated. Owners stay positioned. Owners hold through volatility. Owners benefit when scarcity finally gets properly priced into markets. What we're witnessing right now is a massive shift in how institutional capital perceives risk. Over recent years, enormous amounts of capital moved into financial assets, bonds, equities, derivative positions promising enhanced returns. But underneath all that, beneath the surface that financial media obsesses over daily, something fundamental shifted. People started asking different questions. People started thinking about tail risks, worst-case scenarios. People started wondering what happens if the assumptions underlying financial markets prove wrong. And people started positioning accordingly. Positioning in uncertainty looks completely different than positioning in confidence. In confident markets, you own paper, you use leverage, you embrace complexity. In uncertain markets, you own real things. You own physical assets. You own things that have held value for centuries and will hold value for centuries more. You own things you can actually hold and understand. The 250% surge in physical demand reflects all of that institutional thinking crystallizing into concrete action. It reflects sophisticated investors who spent years analyzing supply chains, geopolitics, and monetary policy, finally saying, "We're done analyzing, we're moving capital now." When serious money moves, prices eventually follow. But prices follow last. Physical capital flows move first. Price is a lagging indicator of what informed capital already understands. Here's what most investors do in moments like this, and I've observed this pattern thousands of times. Most investors focus exclusively on short-term price movements. They look at charts, see something moving up, feel fear of missing out. They buy in, get uncomfortable within 3 months, sell out, then convince themselves the entire thesis was hype. Meanwhile, the actual structural move is still playing out, still making money for people who understood the fundamentals. Most investors ignore physical market data because it's not as visible, not as exciting, not as easy to consume as a price chart. It requires more effort to obtain. It requires separating genuine data from noise. So instead, most people chase what's easy. They chase price. They chase momentum. They chase whatever appears on their phone screens. When those things fail, they panic and sell into weakness, missing the real move entirely. Disciplined investors think differently. They watch capital flows. They study supply reports. They understand geopolitical dynamics. They separate market noise from actual signals. They care more about whether demand is genuinely strong than whether price moved 3% yesterday. They care more about whether supply is genuinely constrained than whether some news story created temporary volatility. Here's the critical difference between someone building lasting wealth and someone stuck in cycles of financial frustration. Wealth builders position early. They position patiently. They understand that the most profitable positions are ones that look boring for months before becoming obvious. The positions that generate real returns are positions taken when nobody cares, when everyone is distracted, when narratives haven't shifted yet. Then you hold while everyone else catches up. By the time everyone finally pays attention, you're already substantially ahead. That's the playbook. That's always been the playbook. That's how institutional capital operates. The rebound we're seeing isn't hype. It's not manufactured. It's not some algorithm-driven spike reversing in 3 months. It's real because it's built on genuine demand and genuine constraints. Physical demand doesn't spike 250% on speculation alone. It spikes because something fundamental is shifting. It spikes because real supply is genuinely constrained. It spikes because buyers who must own something are willing to bid prices up to acquire it. When that kind of demand is genuine, driven by real need and real scarcity, price eventually follows. Not immediately, not smoothly, but it follows. And the people who understood the demand shift before prices started moving are the people who capture the returns. Think about the current environment. We're in a period of genuine geopolitical uncertainty. Supply chains are fragile and contested. People are questioning whether financial assets are worth their supposed valuations. In that environment, real assets become more valuable. Physical ownership becomes more attractive. When serious capital shifts from financial assets into physical assets, physical demand rises, supply tightens, and eventually price reflects that reality. Most people will only recognize this once it's completely obvious. They'll wait until physical demand is no longer surging. They'll wait until prices have already moved significantly. They'll wait until narratives have changed and every financial outlet is discussing it. Then they'll try to enter at much worse prices than if they'd simply paid attention to signals visible right now. That's not criticism. That's just how markets function. Markets always reward people who see signals before they become noise. Markets always punish people who wait until signals are impossible to miss. Because by the time something is impossible to miss, you're entering at expensive levels, not cheap levels. This is about something deeper than price prediction. This is about understanding how capital actually moves. Markets aren't random. Markets aren't unpredictable. Markets aren't determined by luck. Markets are driven by incentives. Markets are driven by capital flows. Markets are driven by people positioning ahead of what they anticipate coming next. Right now, people who understand capital flows are positioning for higher scarcity and higher valuations in physical assets. The rebound is real because it's not a rebound. It's a repositioning. It's a structural shift in capital allocation. And structural shifts don't reverse quickly. They don't reverse on bad news or market panic. They persist until fully priced in. Let me give you first principles thinking here. What creates sustainable price increases? Not sentiment, not fear of missing out, not retail traders on social media. Sustainable price increases come from genuine supply and demand imbalances. They come from situations where buyers genuinely need something and sellers don't have enough of it. In that environment, prices rise because they must rise to clear markets. It's not emotional, it's mechanical. What we're seeing in physical demand is exactly that setup. Buyers stepping up, saying, "We need this, we're willing to pay for it, we're willing to wait for it." When enough capital thinks that way, when enough serious money acts on that thesis, supply cannot keep pace. When supply cannot keep pace, prices adjust. That's not prediction, that's logic. Here's what separates people who understand markets from people who don't. People who understand markets know that price is temporary. Positioning is permanent. You might miss a move by a few percent. You might get timing wrong by a few months. But if you understand the structural shift happening, if you understand capital flowing from one place to another, if you understand scarcity tightening somewhere, you're positioned for the long-term move. You're not trying to catch every penny in between. You're trying to be on the right side of the structural shift. Right now, the structural shift is capital moving from financial speculation into real ownership. That shift is real. That shift is happening. That shift is visible in physical demand numbers. And that shift will persist because the underlying logic hasn't changed. Uncertainty drives capital toward real assets. Scarcity drives prices upward. Long-term owners benefit. The people who will do well over coming years are people positioning on the right side of that shift, not people trading it frantically, not people trying to catch every move, not people chasing prices upward. People who will succeed are those understanding that physical demand exploding signals structural change, and they position accordingly. This isn't about being perfectly early. This isn't about catching absolute bottoms. This is about positioning before the majority of capital catches up. Understanding the direction of capital flow and positioning on that side before everyone else figures it out. You don't need to be early. You just need to be early enough. Early enough that when the move becomes obvious to everyone else, you're already positioned to benefit. Most people fail here because they're impatient. They position early. Nothing happens for 3 months. They get nervous and exit. 2 months after exiting, the move accelerates and they miss it. That's not market failure. That's psychology failure. Lack of discipline to hold positions when the thesis hasn't changed. Only emotions changed. Disciplined investors understand markets don't move in straight lines. Markets cycle. Markets have pullbacks and periods where nothing seems to happen. But underneath noise, capital is still flowing where it needs to flow. Supply constraints tightening, demand shifting, real assets becoming more valuable relative to financial assets. If you can hold positions through boring months, you benefit when everyone else wakes up. That's the real skill, not prediction, discipline. The ability to see a signal, act before everyone else, then have patience to hold while markets gradually catch up to what you already knew. The signal is visible now. The data is public now. The opportunity is available now. People who move now will look back understanding they were ahead. People who wait will eventually move understanding they were late. Wealth isn't built by people with magical future insight. Wealth is built by people understanding the present more clearly than others. People who can read the map before crowds see the road. Right now, the map shows capital shifting toward real assets, scarcity tightening, physical demand exploding. Prices will eventually follow. The rebound is real, not hype, not speculation reversing in months. A structural shift persisting because underlying logic is sound. Supply is constrained. Demand is rising. Capital is repositioning. Price will follow. That's not prediction. That's how markets work. Markets reward preparation, discipline, people understanding what's actually happening beneath surface price action. The real money has already moved. The real positioning has already happened. The question now is whether you move before prices catch up or wait until everyone else has figured it out. That choice is yours.